All right, so I believe in the Wellington Fund more than ever right now, especially if you're a soon-to-be or recent retiree. Now, for the record, I do not own Wellington. Just FYI, I don't. I own no bonds, but I'm still contributing to my M1 Finance account and throwing it all into VTI, the Vanguard Total Stock Index. I do not own Wellington. However, let's be honest here. The market fell 35% in basically 30 days time. Never seen such a quick, violent destroying of wealth as we saw during that time. And then the market proceeded to come back 35% in a few months time, which is insane. I mean, to see that rise of that so fast was nuts. Market fell too quick, market came back too quick. I truly believe that. All right, so, but the problem with the S&P 500, which is market cap weighted, the problem for the S&P 500 is also what makes the S&P 500 such a glorious investment for sure for people building wealth, not decumulating, but actually accumulating assets. I cannot stress the difference. You got to understand. When you're building wealth, you're accumulating. Old Josh, your old buddy, 50 years old. I'm putting money into VTI every 2 weeks. I put money into VTI. Money going into that. VTI is a total stock index. Because I'm in accumulation mode. I'm willing to take risk in order to maximize my growth. And there's lots and lots of data of momentum investing. And that's what a cap weight index is. It says, look, we're going to have more and more representatives of the stocks that are doing the best. And this is the problem now. When those stocks are tearing it up like crazy, you get more bang for your buck. That's all there is to it. Conversely, when those stocks get hammered, i.e. 2000, you get more pain for your buck. So there's more upside, certainly, and a hell of a lot more downside. I don't mind the downside because I'm in accumulation mode. I can deal with that. Easy peasy, man. I just keep plugging away, buy more shares at a cheaper cost. If you've retired, you can't afford that kind of chaos. You can't. Now, that doesn't mean you shy away from the S&P 500 index fund. I'm just saying you need to diversify because you take your gains off the table, essentially. The money you lost, you've all gained back. And now you say, look, let me spread this risk amount to another little bit of investments that will smooth the downside when it comes, because it's going to come. And Wellington's perfect for that because Wellington is value stocks, 65% value stocks. All right, and so value stocks have been the redhead stepchild for basically 10 years now. Value stocks are not what's making the S&P 500 tear it up. Again, the S&P 500, the reason it is on such a tear is essentially 5 stocks. I think it's Microsoft, Apple, Netflix, Facebook, and Google, I think. Anyway, those 5 stocks are and Amazon. Amazon's in there too. Microsoft, Apple, Amazon, Netflix, and Facebook. No, Google's in there too. Maybe it's not Netflix. I don't know. But anyways, those 5 stocks. Maybe it's not Microsoft, but either way, it doesn't matter. So 5 stocks are tearing it up. Amazon's definitely in there, making the index go higher and higher and higher, which in this case now represents, those 5 stocks represent 23% of the index. 23%. Now, in of itself, as a financial planner, that doesn't concern me overly much because you don't want, financial planning 101, you do not want more than one position to represent more than 10% of your portfolio. So let's just put it this way. You work for Exxon Mobil and you got $1 million, 500,000 Exxon Mobil stock, 500,000 in cash. That's not good. That means Exxon Mobil, that one position represents 50% of your portfolio. All right, so when you go back to the S&P 500 and 5 stocks represent almost 25% of the market cap, you could say each of those stocks is only 5% of your portfolio. The problem with that, though, is they're all in the same sector, tech-oriented sector for sure. And the bulk of those stocks don't have any price to earnings ratios. They're all nosebleed, not all, but quite large nosebleeds in terms of price to earnings ratio. So very, very expensive. All right, so what you got to do is you say, look, I'm going to Get out of that position, not sell it. I'm just saying diversify it. And I'm going to go into the stocks that have underperformed for the last 10 years, which would be value-oriented stocks for sure. On top of that, the Wellington does have bonds. And as much as I am not a fan of bonds for accumulation, I am a fan of bonds for protection of the downside. And I cannot be clear enough, and I don't think I have been enough. I need to be clearer going forward. When it comes to investing, there's two types of investors. One in decumulation mode, they're pulling money to live on. Another in accumulation mode, they're adding money to the account. Two completely different types. Accumulators, Josh, we can handle an S&P 500 falling off a cliff. Decumulators, retirees, they just can't. I'm telling you, the sequence of return risk is valid and it is real. And if we go into consecutive years of down markets, a la 2000, 2001, and 2002, a la 1973, 1974, a la going back to 1929, 30, 31, 32, your goose is cooked, man. You can't have that. But if you look at what Wellington did in 2000, 2001, and 2, Wellington was actually up in 2000 and 2001. Now, can you attribute that to the bonds? Yes, you can, absolutely. But you can also attribute that to the value stocks didn't get crunched nearly to the extent that growth stocks did, especially large cap growth stocks in the tech sector, which was a huge proportion of the S&P 500 index back then. Man, you've got to watch that. And you've got to take your gains and minimize some of the risk going forward if you are in retirement mode. You got to get that done, man. And I just look at some fund like the Wellington, it's like perfect. So because it's large cap value with bonds in there as well. The bonds will give you no growth. I get that. Growth isn't what we're shooting for in retirement. We're shooting for steady growth, but we've got to watch the downside. Once you're retired, the downside risk is your enemy. So much more so than not getting as much growth on the upside. This is where all these financial gurus, they totally miss out. They're like, oh man, this fund did that fund did this, so you should have this fund. That's great if you're in accumulation. It's not great if you're in decumulation. If you are pulling money out, you can't afford the sequence of return risks that the momentum stocks will give you. Again, momentum is when the market cap, i.e. momentum, the bigger the market cap, and again, market cap is simple, price per share times number of shares outstanding. That gives you your market cap, all right? So we got a $2 trillion market cap in Apple now, $2 trillion. That's gonna be the biggest constituent of the S&P 500. Maybe Amazon's there, I don't know. But either those two guys are going to have market caps that dwarf the average S&P 500 stock because they're so much bigger. And that's good for momentum. It's bad for retirees because that simply means they're growing. And when they get crunched, it's going to be painful. And this is the problem, frankly, with investing, trying to pick stocks, trying to time the market. Because the market is always led by a few stocks, that's it. And if you don't have exposure to those few stocks, you will underperform. Which is bad if you're trying to grow your wealth. It's not nearly as bad if you're trying to live off your wealth though. I hope this makes sense. Love to hear your comments. Thanks.